So for you as a business owner, the sky's the limit. In order to take a deduction under the code, it has to be ordinary and necessary for what you're doing. So every business is different, but as long as you can look at your business and make sure that you align your facts with what you're trying to do, then ultimately you can deduct almost everything. And so there are huge opportunities. We still have bonus depreciation is still in play. So if you buy any equipment, you have opportunity to that. Meals and entertainment, not entertainment, but meals now, travel, auto expense, home office. I mean, like I said, it continues to go and go and go. The Inflation Reduction Act included huge opportunities for solar. If you've got a commercial office building, maybe you put solar on it, you can get up to a 70% tax credit this year on that. And on top of that, if you don't have a tax liability, the IRS is giving you an opportunity, you can sell your tax credits now. So not only do you have the opportunity to get a tax credit, but if you can't use it, you can sell it. There's awesome. Yeah, I mean, there's a huge opportunity. The Secure Act 2.0, which was signed into law in December, has incentives for setting up retirement accounts where they'll actually pay for the setup of the retirement account. So ultimately it will be a dollar for dollar credit. Really when you look at businesses, what I say is look at what are you trying to do and ultimately align yourself to what you're trying to accomplish. And then ultimately everything would be deductible. So if you're saying, I want to do this, then how can I make that ordinary and necessary? What is it that I need to do to make this an ordinary and necessary deduction so that I'm aligned with the law and I'm not doing anything that's in the gray areas. I'm doing everything by the tax law, but it's ordinary and necessary so I can deduct it.
So can a business owner, let's say a dentist that owns his practice, take advantage of bonus depreciation in a real estate investment scenario?
No. I mean, they'll get a passive loss if they're not involved in that investment. Now, if they're a dentist and they own the structure that they're practicing in, that's a different story because now that's, one economic unit. And yes, then they would be able to do a cost segregation study and use the bonus depreciation from that asset to offset the income from their business.
So the law would apply as if he was a W-2 also investing in a syndication, same exact thing in that scenario, if he was investing in somebody else's deal.
Correct. His income as a dentist is active. His losses from the real estate are passive because he's an LP investor in that.